Yesterday, we people started with AS 22, accounting for taxes on income, and we learned the concept of deferred taxes, and that is deferred tax asset and deferred tax liability. And we also saw in which circumstances deferred tax assets or liabilities are created. It is just because of the timing difference, and this timing difference does not allow your accounting income to get matched with the tax expense. So to fulfill the matching concept, we create either a deferred tax asset or a liability so that your accounting income is matched with the income tax also as per the accounting only. Because you have already seen yesterday that in our P&L account, the provision for tax we debit is as per the income tax liability, but the income is shown as per our normal accounting procedure. So that income and the tax figure do not match, right? So there is a violation of matching concept. So to fulfill that, to match it, we record deferred tax. So provision for tax, that is called as your current tax, plus or minus the deferred tax that you are creating together will now match with your accounting net profit. So your accounting for taxes on income, that is AS 22, with the help of deferred taxes matches your income with the taxes those are debited in the P&L account, right? And yesterday we saw many examples as well, and now we have to go ahead. Now yesterday I think I had stopped at this point, that deferred tax asset or liability to be recognized will be nothing but the timing difference multiplied by the tax rates enacted or reasonably enacted on the balance sheet date. Now, please understand, what do you mean by enacted or reasonably enacted on the balance sheet date? Now, say for example, if your balance sheet date is 31st March 2001, so as on this date, which is the act which is giving you the tax rate? Sir, I think on this date, I would say Finance Act 2021 has already been issued, and this has been issued on 1st February 2021. So technically, I can say on your balance sheet date, this is the act which has given the applicable tax rates. But sir, already I think your income tax lectures have been started, and you might have been aware with one thing, that Finance Act 2021 is not applicable to financial year 2021. Technically, Finance Act 2021 is applicable to the financial year 21-22, or in income tax terms, you call it as assessment year 22-23, right? But sir, we are creating the balance sheet on 31st March 2021, that is this year's balance sheet. And while creating this year's balance sheet, we should create deferred tax by applying the tax rates of the next year. Yes, sir, because that is what law says. It says tax rate enacted or reasonably enacted on the balance sheet date. So on this balance sheet date, this is the act which is into force, Finance Act 2021. But technically, Finance Act 2021 is applicable to the next year, not to the current year. So still, you have to create the deferred taxes based on the tax rates of next year. Sir, why? I can give you a simple answer. Whatever deferred taxes you are recording today, its impact on the taxability will be in this year or next year. So technically next year, because these effects are going to reverse in the next years. Right? That is why we always create the deferred taxes as per the tax rates of next year. But sir, in India it is not a problem because our tax rates are generally same only. Right? So we have some questions where the tax rates will be different in different years. So we will be solving such questions as well, not to worry. So always make a thumb rule. In small questions, they will give you only one tax rate. So nothing to look forward or back. You can directly create the deferred taxes on the rates which are given. But we will be having some questions where you will be given dates, or I would say you will be given rates of the future years. So always remember, whenever you are recognizing or reversing, I will repeat, recognizing or reversing a deferred tax asset or a liability, the tax rate of the next assessment year should be applicable, not this assessment year. Or in simple terms, of the next financial year, not of this financial year. So when you are on 31st March 2021, that is financial year 2021, and you want to record or reverse a deferred tax, you will apply the rate applicable for financial year 21-22. But sir, in India, I think the rates are flat. That is 30% for corporates. So this problem generally will not arise in India, at least. Right? And one more point, yesterday we had gone through that, sir, deferred tax assets has to be recorded with respect to prudence. And what is that prudence? Virtually you can see profit. Means one statement we learned yesterday. We have a reasonable certainty of no reason to believe that there will be losses, no reason to believe that there will be losses in the future year, that is in the next year. So say for example, I am on 31st March 2021 and I want to record a deferred tax asset. So what I have to check for the next year, that is financial year 21-22, do I have a reason to believe that I will have losses? Sir, no, I don't have any reason. My business is going superb. I will earn profits only. So technically there is no reason to believe that you will have losses. Sir, no. Record the deferred tax asset. But say, as on 31st March 2021, when you are planning to record a deferred tax asset, and you have a reason to believe that there will be losses in next year. So in such case, sir, you cannot record deferred tax asset. You cannot record. You have to hold. You cannot record deferred tax assets. You have to postpone the recognition to next year. So next year means 31st March 2022. Yes. So on 31st March 2022, I can record. No. Again, you have to check the same prudence logic. That do you have reason to believe that you will have loss in next year? Yes, sir, I still have the reason. Don't record now also. Take it again to the next year. Right? So whatever part of the timing difference is left over, only that will be checked in the next year. Because say in first year 100 rupees arise, right? But out of that second year 40 rupees reverses. So what is left timing difference at the end of second year? Only 60 rupees. So you will check for that 60 rupees, that whether you will record a deferred tax asset or not. Right? So every year end, see, these are two concepts now. These are two concepts, and these concepts are called as reassessment and review of deferred tax asset or liability. Now, when I say reassessment means deferred tax asset not recognized in earlier year means condition not satisfied. Condition means condition of prudence not satisfied. So check whether to be recognized in current year or not. So what to check? Sir, same prudence condition check again. So if the prudence condition is satisfied, record now. If not, again take it to the next year. So what will be taken? Sir, the timing difference which is left over. Because there is a chance that in 1 year timing difference arise and in second year it may reverse. So after reversing whatever the timing difference is left, for that you will check. Correct? That is point number 1. And point number 2 is review of deferred tax asset or liability. Review means the deferred tax asset or liability which is already recognized earlier to be reassessed on every balance sheet date. That is, any further deferred tax to be recorded or it is to be reversed. So if whatever deferred taxes we have recorded at every balance sheet date, it should be reviewed. Correct? Review, check. Anything reversing? Yes, reverse it. Further you want to create it. And sometimes it may happen, tax rates are changed. We talked about it yesterday. That sir, we created deferred tax at 35% last year. But now the tax rate has increased to 40%. So what to do? Sir, last year you created at 35. Now it is 40. So please increase it by further 5%. That is called as reviewing your deferred taxes every year. I hope you are understanding this point. Right? So now I think we should solve some questions. based on the examples that we saw yesterday. And after solving some questions, we will move on to the next 3-4 concepts left over. We will start with question number 1. ABC Limited has provided depreciation as per accounting records 8 lakh rupees and as per income tax records 14 lakh rupees. So can I say taxable depreciation is greater than accounting depreciation? So tell whether we should create DTL or DTA, because the difference because of depreciation is always a timing difference. No second thought. So what to create, DTL or DTA? Vishal has given me an answer, DTL. Aditya, DTL. Bharat, DTL. Majority now, Bala, Haripriya, Sujit, everybody writing DTL. And you people are absolutely correct. Raval, Lavanya, everybody are correct. Because the simple logic, sir. I told, don't always go for what? The logic. Don't go for the magic. I have given you formula yesterday. So it is your choice. You can use the formula and get the answer. I don't have a problem. But please go for the logic. Logic is what? Accounting expense is greater than, taxation expense is greater than accounting expense by 6 lakhs. Right? So when 6 lakhs higher expense means lower net profit, lower tax. So you to pay lower tax today means tomorrow you have to pay higher. It's a deferred tax liability that you have to record for this 6 lakh of timing difference. Further, we have something else in question. Unamortized preliminary expenses as per income tax record is rupees 10,000. Now, sir, if it is unamortized in income tax means this 10,000 is yet to be claimed as an expense, which means in accounts you have already claimed, which means in accounts it is already amortized. That is why you are saying the fact that in income tax it is yet to be amortized. Correct? So this is going to reduce the taxable expense or increase the taxable expense. This 10,000 which is unamortized, not yet claimed, means it will reduce your expense. And reduce your expense means higher profit. And higher profit means higher tax. Correct? So technically, this 10,000 difference because of preliminary expenses is what? Timing difference, creating deferred tax asset. But sir, we cannot have deferred tax asset as well as a liability in the same year. So we can set off each other because both belong to the Indian Income Tax Act only. Because sir, when you will go to CA final level and again you will learn deferred taxes, you will see to it that deferred taxes are also created with respect to foreign taxations. Because in foreign taxation also timing difference will arise. Right? But if you have a timing difference as per American Tax Act, which is creating deferred tax liability, and as per Indian income tax, you have a deferred tax asset, you cannot set them off together because both are with different income tax acts. But in our questions, everything will be as per the Indian income tax only. So deferred tax asset can be set off against deferred tax liability, not a problem at all. So here we are going to do the same thing. 6 lakh timing difference creating deferred tax liability and 10,000 creating deferred tax asset, net off. So 5 lakh 90 timing difference creating deferred tax liability. Tax rate, how much deferred tax asset or liability should be recognized as a transition adjustment? Tax rate is 30%. And see one more point. There is adequate evidence of future profit sufficiency. That is for deferred tax asset. Because for deferred tax asset, you actually want this, right? Correct? You should be having the reason to believe that you will have profits. Correct? So let us solve this question. We'll solve this. I'll solve all the questions for you. Question number 1. Right? First, as per income tax, 14 lakhs minus depreciation as per accounts, 8 lakhs. So I would say 6 lakh rupees timing difference with respect to recognition of deferred tax liability. Correct. So this timing difference of 6 lakh rupees is with respect to creation of deferred tax liability. Then unamortized preliminary expenses rupees 10,000 as per tax requires recognition of deferred tax asset. So therefore, net timing difference, net timing difference to record DTL net, it will be 6 lakh minus 10,000. So sir, with a timing difference of 5 lakh 90, we have to create the deferred tax liability now. So therefore, DTL to be recognized will be equal to 5,90,000 multiplied by 30% tax rate is given in the question. Now these are small questions, so only one tax rate is given, that is only applied. So it is 1,77,000. Correct. So because of this timing difference, matching concept problems arises. So when you record this 1,77,000 in your profit and loss account, your matching concept problem will be sorted. Electricity gone. Yes, Sumuk.
Hello, sir. Yeah, I just have I just want one clarification regarding the unamortized preliminary expenses. So basically, you're saying that once it gets amortized, that means the expenses are spread out through that many years. So you won't be, the full expense won't be charged this year. And because of which expenses become less and profits become more, right?
Exactly. Profit, expenses are less and profit will be incurred. And this is one part of expense which is yet to be debited.
So once it is done, then it is our, the expenses will reduce.
Yes, means this, for example, this has arisen today. So next year this will reverse. So next year you have to pay technically 3,000 less tax.
Okay. Yes, sir. Thank you.
Yeah. Just a minute, Vishal. I'll just get an emergency light. Just wait. Yes. Yeah, Vishal, please speak.
Good evening, sir. In this question, we have recognized the direct tax asset, but in the end, we are setting it off with the liability, sir. But even if you are setting it off with the liability, still, the criteria should be met that there should be adequate profits in future. Even if you are
exactly.
Okay, sir. Thank you.
If there is no reason to believe, if there is a reason to believe that you will not have adequate profits, then my deferred tax in this case would have been 6 lakh into 30%, 1,80,000 DTL.
Okay, thank you.
Yes, you are correct. Now let's see the second question. Now, second question is something more in detail. We'll be going with journal entries and all. Cost of the asset purchased in year 1 is 200 lakhs. Depreciation book at the rate 20% straight line method. And as per Income Tax Act, 100% depreciation you are getting in the first year itself. Now, sir, there are some sections which can allow you 100% depreciation in the first year itself. Section 35 AD, investment in specified business, which gives you 100% deduction of capital expenditure in the first year itself. Then capital expenditure incurred for scientific research, section 35. So for scientific research also, if you are purchasing any fixed asset, you get 100% depreciation in the first year itself. So it is probable, not to worry. It is correct. PBDT, that is nothing but profit before depreciation and tax, is given at 200 lakhs each for years 1 to 5. Rate of income tax is given at 50%. Calculate deferred tax and show the journal entries. So technically, sir, you have to show it for 5 years, right? Now, please understand, in the first year itself, you are going to claim full 200 lakh depreciation in income tax, correct? But sir, in accounts, you are going to get 20% each year. So if you compare the first year, accounting debris will only be 40 rupees and income tax debris will be 200 rupees. So in first year, 160 rupees difference of depreciation will arise. And that is timing difference arised. And this is going to reverse from second year to fifth year. Because technically in the second year, third year, fourth year, fifth year, income tax depreciation will be 0. Because you have already got 100% in first year. But in all these 4 years, second year, third year, fourth year, fifth year, accounting debris will be still 40 rupees. So I say that the scenario has changed because in the first year, taxation debris was greater than accounting debris. But from second year onwards, accounting debris is greater than taxation. So I can say reversal starts from the second year to the fifth year. And exactly 160 rupees will reverse. Because in first year, 160 rupees timing difference arise. And second year to fifth year, for all 4 years, 40 rupees will reverse. Right? So in the year 1, we have to create a deferred tax liability. Ritik has given me all the answers. We have to create deferred tax liability in the first year. And from the second year to fifth year, the deferred tax liability will be reversed. Because in first year, what is the logic? The difference of 160 timing difference. So you are having more debris by 160 rupees in income tax. More debris means lesser profit. Correct? And lesser profit means lesser tax. Correct? So in year 1, you are paying less, but not to worry. In year 2, 3, 4, 5, you will pay more. Right? Because in 2, 3, 4, 5, income tax debris will not be there. So if debris is not there means in second to fifth year, higher profits. Higher profit, higher tax. Right? So this is going to be a lengthy question. First time you are solving such, oh yeah, got the power back. Yeah. So this is the first time you are solving such type of a question. So we will show in a very proper manner by showing the comparisons also, and we have to give the journal entry also. So this is accounts and this is income tax. Correct? Year 1, 2, 3, 4, 5. Year 1, 2, 3, 4, 5. Correct? Year. Profit before depreciation tax. 200 each year. PBDT. 200 each year. Correct? Now, less debris.
Now, can I say in accounts every year you are going to get 40 rupees of depre because 200 is the cost of the asset and 20% straight line method depre. So 40 rupees of depreciation is what you are going to claim in all the 5 years. So profit before tax you will have 160, 160, 160, 160 and 160. But when it comes to income tax, entire 200 depreciation in the first year itself, but in all other years it will be a dash. Correct? So what will be my profit before tax? In the first year it will be nil. In the second year 200, third year 200, fourth year 200, fifth year 200. Correct? Now I want everybody to please focus. Don't write anything. Please focus, because once you understand this, the entire question is over. Now, sir, we have solved till here, right? Now, let us understand the tax that we have actually liable to pay to the government. So let us go into IT part first. So less tax at the rate of 50%. So can I say first year nil tax? No, nothing I have to pay to government. But sir, from all other years, I have to pay 100 rupees tax to the government. Yes or no? Correct? So I will have a profit after tax nil in the first year and 100 rupees for all the other 4 years. Correct? Is everybody clear with this point? Now, we have already learned yesterday that whatever tax you are actually liable to pay to the government, that is called as the current tax. And current tax is always recorded in the profit and loss account as a provision for tax. Yes or no? So let us record the provision for tax first. So provision, when you create, it is definitely a subtraction. Minus provision for tax. So how much provision I will create? Nil, 100, 100, 100. Correct? Now arises the problem of matching concept. Correct? Now matching concept has arisen. Problem, violation done. Why? Sir, if you check, the net profit for all my 5 years is 160 rupees. So how much should be my tax that is to be debited to PNL? 160 into 50%, 80 rupees, sir. How much is getting debited? 100. First year, nothing is getting debited. But for all other years, 100 are getting debited. So it is not correct. My matching concept is not satisfied. Right? So first year, because of the timing difference of 160, I am paying nothing as per income tax. Right? I am paying nothing as per income tax. So I am paying less today. Tomorrow I have to pay more. Correct? So today I will be creating what? A deferred tax liability. And when I create a deferred tax liability, my P&L will get debited with a tax figure of exactly 80 rupees. And that is only what I have to debit to my P&L for tax. Because, sir, 160 is my profit as per books of accounts. The relevant tax expense should be how much? 80 rupees. Correct? So I will show less DTL recognize in the first year 80. Right? And we get profit after tax 80. Correct? So please
Yes, audible now? Okay. Just wait for a minute. Screen sharing will start.
Yeah. So what I was writing is, in the first year, timing difference of rupees 160 lakhs arise because of difference in depreciation charge. That is 200 as per income tax and 40 rupees as per accounts. So 160 rupees timing difference arise. This timing difference leads to recognition of deferred tax liability in year 1. So therefore, DTL to be recognized will be nothing but 160 of timing difference multiplied by 50%, that is 80 lakhs. And sir, that is what I have also shown over here. So if I record 80 rupees of deferred tax liability, then I can say my matching concept gets fulfilled, because against my profit of 160, 160 into 50%, 80 rupees should be my tax that has to be debited to PNL in the form of deferred tax liability. So my profit after tax is 80 rupees. So everybody please look at the journal entry of the first year. Your journal entry will be P&L account. This is all rupees in lakhs. P&L account, debit 80 to deferred tax liability account 80. And sir, only for your reference, I am also showing you the formula. Tax expense is equal to current tax plus or minus deferred tax, correct? See this formula. Tax expense means the tax that should be debited to PNL. Now, how much tax should be debited to PNL? 160 net profit multiplied by 50%, 80 rupees. Correct? Tax expense is nothing but tax as per books of accounts. So tax as per books of accounts is 80. That is equal to current tax is nil. Current tax is nil. So we are having a plus over here. Plus 80. So this is nothing but deferred tax liability. Correct? Correct? Timing difference. Right? Now, sir, everybody please focus. If you see, from the second year to fifth year, the accounting treatment in all the 5 years will now be same. Why? Sir, from the second year to fifth year, in accounts we have 40 rupees of depreciation every year. But in income tax, we don't have any depreciation. So now we will say the situation has reversed. Means the timing difference of 160 that has arisen in the first year now gets reversed from the second year to the fifth year at the rate of 40 rupees per annum. Right? So technically on this 40 rupees, 20%, sorry, 50%, that is 20 rupees of deferred tax liability should now be reversed. So technically 80 rupees that you recorded in first year will now start to reverse as 20, 20, 20, 20 in all the 4 balance years. And sir, I can show you the logic also. Now check in the second year. Profit is 160. So how much should be tax? Only 80. Only 80. But how much have you debited? 100. To reduce the effect, 20 has to be credited. Now 20 credit means what? Reverse DTL. Because when you reverse DTL, your journal entry will be what? DTL account debit to P&L. So technically now I will say from the second year onwards, DTL reverse. And sir, in all the 4 years, 20 will reverse. That is 40 rupees of exact 40 rupees timing difference is getting reversing. So 40 into 50%, 20, 20, 20 will start to reverse. And finally, you will have profit after tax of 80 for all the years. We will show it properly in the working note also below. Right? So you can see the difference. 40 of depreciation charged every year in accounts for next 4 years. But in income tax, thinga, 0. Right? So technically, 160 difference which arised in the first year has now reversed from second to fifth year at 40 rupees per annum. So technically, with respect to 40 rupees of timing difference that is reversing, what is the deferred tax liability to be reversed? So deferred tax liability to be reversed will be equal to timing difference multiplied by tax rate. So timing difference is 40 rupees reversal multiplied by 50% tax rate. So sir, technically for second to fifth year, we need not write all the 5 years. We will directly show that from the second year till the fifth year, comma, the timing difference with respect to depreciation claim is reversing at rupees 40 lakhs per annum. Correct? So therefore, deferred tax liability should also be reversed with respect to the reversal of timing difference. So therefore, deferred tax liability to be reversed every year from year 2 to year 5 will be equal to 40 multiplied by 50% tax rate. So sir, rupees 20 lakhs per annum is what you will reverse. Sir, can you tell us the journal entry? Yes. Journal entry, it is rupees in lakhs. So everybody please focus on the journal entry now. Journal entry, you can make it from the P&L itself. How much should be debited to P&L? Sir, P&L, it should be debit, have a net effect of 20 rupees. Correct? So P&L debit 20, P&L debit 80. Right? Deferred tax is also reversing. So when you reverse the deferred tax liability will also get debited. Right? 2, provision for tax 100 rupees. So you can either pass one journal entry or you can also pass 2 different journal entries. I'll show you that also if anybody has a confusion. PL account debit 80, deferred tax liability account debit 20, to provision for tax account 100. Or 2 entries you can pass. The first entry will be PL account debit 80. Oh, sorry, provision is 100. Sorry. So PL account debit 100 to provision for tax account 100. This is first entry. And second entry will be DTL reversal, that is DTL account debit 20 to PL account 20. And technically the merger, this is nothing but merged entry. So you can pass anyone with which you are comfortable in exam. Yes, Anshul.
Sir, could you scroll up, sir?
Wait, others are copying. What happened? Tell.
So the depreciation part I didn't understood, sir. What you said, sir?
What you did not understand.
That from the second year, that 40 lakhs per annum, sir. The difference is actually 20, right, sir? Means 100 lakh is the tax as per account should be 80, but we are making a provision of 100. So 20 lakh extra is a deferred asset, right, sir?
Deferred tax
Tax,
liability which is
yeah.
reversed.
Deferred tax asset also, we can also say.
Reversal of DTL can be called as deferred tax asset, but don't call it as a deferred tax asset. Call it reversal as reversal of DTL.
Okay. So, sir, what actually I didn't understand what you wrote, sir, regarding the depreciation part, the claim of 40 lakhs, sir.
20 rupees is coming because of depreciation difference only, na?
Ah, sir.
You check depreciation in accounts from second year to fifth year. I've written it so clearly. If you read, you can clearly understand.
From the second
From
year.
second year to fifth year, the timing difference with respect to depreciation claim is reversing at 40 per lakh. See, reversal starts in accounts from second to fifth year. You are having 40 rupees of depre. Hey, when I explain what you do, Anshul, 40
I was listening,
rupees,
sir.
40 rupees depreciation is available in accounts from second to fifth year. But is it available in tax?
No, sir.
So that is called as reversal now. Because in first year, the scenario was opposite. In first year, in accounts, you got 200. In tax, you got only 40. So technically, 160 rupees extra depreciation. So technically, 160 rupees, you have taken extra depreciation. Extra depreciation in tax, which is not there in accounts. So we say timing difference arise in first year, but it will reverse from the second year, na? Because in second year, the situation is now opposite. Because accounting depreciation from the second year is greater than taxation depreciation, right?
Account, yes,
So
sir.
situation is reversing. And because of this reversal situation, deferred tax liabilities has to be reversed.
Yes,
Because
sir.
of the arisal in first year, we recorded deferred tax liability in first year.
Yes, sir.
And now we are reversing the deferred tax liability.
So we cannot use the word deferred tax asset, right, sir?
No, please don't use it. No.
Okay, okay, sir.
Yes, Ritik.
Sir, so like if there is a reversal of something that was previously created, supposing there is a DTL and we are reversing it, so we cannot use the word DT.
No.
But if so what I understand is, sir, like there will never be a deferred tax asset and deferred tax liability existing at present, like at the same time in a balance sheet.
Together generally we don't have.
There will never exist both the things.
See, some people, even after they are allowed to set off, they don't. They show it differently also. Because they say that deferred tax liability is with respect to one type of timing difference and deferred tax asset is with respect to some other timing difference. So some people show it.
Okay.
For their convenience. But AS22 has clearly said you can set off both against each other and show anyone.
Okay.
That is possible. You know, which part you are pending to copy? I am going to give you the PDF, not to worry. Which part is pending? If anybody goes, somebody is telling scroll up, somebody is telling scroll down. I'm not able to understand what to do exactly. I've shown the entire solution in one page now. You please zoom it in your respective devices. Yeah. So let's go now to the next question. We will go for question number 6 first. Omega Limited is working on different projects. Those are likely to be completed within 3 years time period. Okay. It recognizes the revenue from these contracts on percentage of completion method for financial statements. So they are using PCM method. These are contracts. So I think they are applying AS7 percentage of completion method for recording the revenue in the books of accounts. So for 2006, 7 and 8, the revenues that they have recorded in books, 11 lakh, 16 lakh, 21 lakh respectively. However, for income tax purpose, it has adopted the completed contract method, under which it has recognized revenue of 7 lakh, 18 lakh, 23 lakh for the years 2006, 7 and 8 respectively. Now, sir, please see, these are not expenses, these are revenues. So please give your answers properly. First year, second year, third year, in all the 3 years, there is a difference of income. But if you check the total income, it is 48 lakhs for both. Because incomes cannot be different. Amount in every year can be different, but total income has to be the same. So you can clearly see in income tax, first year 7 lakhs, but in accounts 11 lakhs. So technically, as per income tax, you are showing lower income by 4 lakhs. So 4 lakh is the timing difference. 4 lakh is the timing difference because of which your tax will reduce or increase. Give your answer wisely. It will reduce because lower income means lower profit, and lower profit means lower tax. So what will I create? A deferred tax liability or a deferred tax asset with respect to this 4 lakh timing difference? It is purely deferred tax liability in the first year. I explained so clearly now. You are showing 4 lakh lower income. So lower income means what? Lower profit. And lower profit means you are paying less today. So when you pay less today means you are creating what? A deferred tax liability. Right? But exactly in the second year, income tax income is 2 lakh greater than accounting income. And in the third year also, 2 lakh income as per income tax is greater than accounting. So technically, sir, the 4 lakh difference that has arisen in first year, it is getting 2 lakh reversal in second and third year. So technically, DTL is reversed in the second and third year because timing difference is also getting reversed. I hope you are understanding this point. Income tax rate is 35%. Compute the amount of deferred tax asset or liability for these 3 years. Correct? So what should be the amount of deferred tax asset or liability is what we have to show for these 3 years. So sir, we will show it in a proper tabular form. So I made a table for the morning batch. I'll just copy paste the table first. So this is the table that we will be requiring. I want everybody to please draft the table accordingly. Yes, Mohit.
Sir, just a confirmation, sir. If we are paying more in the future, we have to pay a deferred tax liability today.
Yes, because it is a liability in the future.
And if we pay less in future, now it's a deferred tax asset.
Yes, because today you are paying more, so in future you need not pay more. You need to pay less.
Okay, that's one. Thank you, sir.
Right. Okay. So this is your table that you have to draft. Accounting income, taxable income, timing difference arise, timing difference reverse. So deferred tax liability to be recorded and deferred tax liability to be reversed. Just hold and check I'm drafting the table first, then you can copy it down in the next 3-4 minutes, because then it will be just copy paste for you. Please focus. Accounting income in the first year is 11 lakhs and taxable income is 7 lakhs. Correct? So can I say in 2006, timing difference rupees 4 lakh arise? Correct? Therefore, DTL recognize. Yes or no? So timing difference 4 lakh is arising. So DTL will be recorded at 1 lakh 40. Sir, how did you get the answer? 35% tax rate is given, na? So what is DTL? Timing difference multiplied by tax rate. Correct? So 4 lakh multiplied by 35%, 1 lakh 40 DTL to be recorded. Right? So for first year, no need to pass any journal entry. This is just for your sake. First year, your entry will be PL account debit 1 lakh 40 to DTL 1 lakh 40. I've recorded the deferred tax liability. Now second year, accounting income is 16 lakh. Taxable income is 18 lakh. So I would say for 2007, timing difference reverse rupees 2 lakhs. Therefore, DTL reverse. Correct? So I would write in the reversal column 2 lakh reverse. So how much DTL you will reverse? Exactly 70,000. So what journal entry will I pass? Sir, I will pass the opposite entry. DTL account debit 70 to PL 70. Correct? And third year, accounting income is 21 lakh. Taxable income is 23 lakh. So again, it is not arisal, it is reversal. Right? Because only the first year situation was what? Accounts was greater than tax. But from second year, situation is opposite now. Taxable income is greater than accounts. Right? So second year reverse. Third year also same. Taxable greater than accounts. So second and third year getting reversed. Same 70,000 reversal. So for 2008 also, I will write the same point again. In 2008, timing difference 2 lakh reverse, therefore reverse your DTL. And journal entry will also be the same. So in exam, no need to pass any journal entries. Just draw the table, more than sufficient. Please copy down. Please copy down. And go for a next question. And this question is now going to be a bit tricky. Now we are going to do two questions back to back. Question number 7 and question number 3. Now these two questions are based on the concept of what you know, review of deferred taxes. That is, at every balance sheet date, you have to cross check whether whatever deferred taxes you have created are as per the proper tax rates or not. If there are any changes, you have to either create further deferred tax or you have to reverse. Right? So very, very nice question. Question number 7 and question number 3 both. So please focus carefully. Question number 7. Dilemma Limited has operating profit before taxes and depreciation of 500 lakhs in each of 3 years. The company purchased a microcomputer for 240 lakhs in the beginning of year 1. The expenditure was fully allowed as a deduction under Section 35 of the Income Tax Act. Section 35 scientific research expenditure, and you are going to get full 240 lakh deduction, means in first year only full depreciation. No problem, sir. However, the company has decided to amortize, that is depreciate the expenditure over its useful life of 3 years in the books. So technically 240 lakh is the cost of computer divided by 3 years life 80 lakh per annum will be the depreciation as per books of accounts. So technically, sir, timing difference has arisen in the first year because of depreciation. Just see this chart over here. IT depreciation is 240. Accounting depreciation is only 80 rupees. Right? So I would say difference of 160 has arisen in year 1. But please check year 2 and year 3. Sir, in year 2 and year 3, only in accounts you will have 80 rupees of depre, but nothing in income tax. So scenario changes from the second year. So I would say from second year, reversal will take place. And technically, 80 rupees in second year and 30 rupees in the, 80 rupees in the third year is timing difference reverse. So technically, this is leading to create a deferred tax liability in the first year, because this is the same question as question number 2, similar question only. So deferred tax liability will be created in the first year and same will be reversed in the second and third year. But sir, the problem is the tax rates are now given to you at different rates. In year 1, the tax is 40%. In year 2, the tax rate is 38%. And in year 3, the tax rate is 35%. Correct? So the tax rates are different in all the 3 years. So now please understand the logic. When you are in year 1, you will create deferred tax as per the tax rate of second year. Remember, always we create deferred taxes as per the tax rate of the next financial year, not the current. So when you are in year 1, you will create the deferred tax liability as per the tax rate of second year. And when you are in second year, you will apply the tax rate of third year. And when you are in the third year, you will apply the tax rate of fourth year. But sir, fourth year tax rate is not given, so we will consider it at 35% only. Calculate deferred taxes if it is assumed that future tax rates are known only 1 year ahead. And sir, only 1 year ahead only we know the tax rates. We don't know tax rates of 2-3 years ahead. Right? Because of the Finance Act, we know that what is the tax rate applicable for next year. So we generally know the tax rates applicable for 1 year in advance. Pass journal entries for all the 3 years. So you have to show the working as well as you have to pass the proper journal entries for all the 3 years. Now people might be wondering, sir, timing difference has arisen in first year, but we are creating a deferred tax as per the tax rate of second year. Because sir, technically it is going to reverse in second year. And some part will get reversed in third year. So accordingly, we have to adjust from second year to third year. When you shift, there is a tax rate difference of 3%. So that adjustment of 3% will play a very vital role, which will become a very, very important part. Because in first year, when you create a deferred tax liability on 160 rupees of timing difference, you will create it at 40%. But when you come to, you will create it at 38%. I'm really sorry. But when you come to the second year, the tax rate would be considered of the third year. So difference between the tax rate of second and third year is 3%. So for that 3%, you have to reduce the deferred tax liability first. Because you have recorded the deferred tax liability at 38% in your books, but now the tax rate is 35%. So 3% has to be reduced. That is the concept of review. Right? So let us show this properly. It's going to be a lengthy solution. Question number 7. Accounts, income tax. Year 1, year 2, year 3. Year 1, year 2, year 3. Profit before depreciation tax. 500 is given. Correct? Minus depreciation. 80 per annum. So profit before tax 420, 420, 420. Correct? Now, profit before depreciation tax as per IT is also same 500 for all the 3 years. Less depreciation. Sir, in first year we will get full 240 and for next other years it will be nothing. So profit before tax 260, 500, 500. Correct? Now, please check. Tax. Sir, in IT, whatever tax rate is applicable for current year, on that only we have to calculate the tax. Can anybody please calculate and tell me? My calculator got stopped working today. So first for 260 at 40%, it will be how much? 104 if I'm not wrong. So balance should be 156 PAT. Then for second year, the tax rate I think is 38%. So what is 38% of 500? 190. So 310, and here I think it is 35%, so 175. So 325. Correct? Now, sir, whatever taxes you have to pay as per the Income Tax Act, the same provision for tax has to be created. Correct? So minus provision. 156. I'm sorry. 104. 190. 175. Correct? Now, minus DTL recognized plus reverse, and finally you will get profit after tax. Right? Now, how much DTL should be recognized? Now, if you directly say, sir, 420 is the profit before tax and directly multiplied by 40%. So you would say that, sir, we have to create my actual tax that should have been debited to the profit and loss account should have been 40%, matlab 80, 168. Correct? 168. So you will say that, sir, DTL should be recorded will be 64 rupees. Correct? Because already provision you have recorded 104. So you would say the DTL should be, sir, 164 rupees. But no, sir, DTL will not be 164. Because next year the tax rate is only 38%. So technically these are going to reverse next year. So you have to create at 38%. So 2% short DTL will be created. So what is the timing difference? 240. 240 into 2% is how much? It is 4.8. Right? So technically only 159.2. Not one, I'm sorry, 1 minute. Some figures are going wrong, it seems. 64 rupees, not 164. I am really sorry. 64 rupees of deferred tax liability is what you see has to be created. But in reality, we will be creating only. This Sujit is giving wrong answer. That is why I went wrong. Sujit, you wait. You're giving wrong answer. That is, I saw his answer and I went on. No. What is timing difference? Let me write. Year 1. Timing difference of rupees 160 lakhs arise due to difference of depreciation as per income tax and depreciation as per accounts. So in the bracket you can show 240 minus 80. Right, full stop. Therefore, deferred tax liability should be recognized on the above timing difference. Correct? At the tax rates of next year. Right, that is important to be noted. Tax rates of next year. So therefore, DTL to be recognized will be, sir, 160 is timing difference multiplied by 38%. Can anybody answer this? 160 into 38%, it is equal to rupees 60.8 lakhs. But generally what people would have told, sir, 160 is timing difference, so into 40%. So 64 rupees is required. Right? But we will not record 64. We will record 60.8 as per the tax rate of next year. So how much DTL should be recorded? So DTL should be recognized will be 60.8. So what will be profit after tax? What will be profit after tax? No, this is because the tax rate no in advance. No, sir. Logic is what you have to always create deferred tax as per the tax rate of next year only. In the previous questions, they are telling that the tax rates are same. And in India also, this is not a problem because the tax rates are actually same. They are same flat 30, or 25% only. Profit after tax is 255.2. So, sir, what will be the journal entry? Journal entry will be P&L account debit. Now, P&L is debited with total 164.8 to deferred tax liability account 60.8 to provision for tax account 104. So this is your first year completed. Now, sir, technically in the second year as well as in the third year, the timing difference is going to reverse at the tune of 80 lakh rupees per annum. Because you can clearly see it from the working note itself. In accounts, in the second year, you have 80 of depre, and in accounts, you have third year 80 rupees of depre. Correct? But in IT, you don't have depre in the second and third year. It means timing difference has started to reverse. Now here is the very, very important point and where student makes a mistake. Please focus everybody. Timing difference of rupees 80 lakhs will reverse in the second year, full stop. So the DTL should also be reversed as per tax rates of next year, that is third year. Now here is the biggest important point that everybody has to note where student can make an error in exam. So therefore, deferred tax liability to be reversed. Now, please understand, last year we created a deferred tax liability on a timing difference of 160 rupees at 38%. But can I say in the current year, the tax rates have now been shifted to 35%, yes or no? So can I say there is a 3% dip in the tax rate? So you have recorded the DTL in your books at 38%. So sir, first, please reduce that. So reverse the entire DTL first by 3% on entire 160 rupees, because you have created deferred tax liability on entire 160 rupees. So on entire 160 rupees, you first reduce it. And then what will happen when you reduce 3%? Automatically your entire DTL is now coming back at 35%. And then you can reverse 80 rupees also. Now what will happen if you don't reduce this 3%? I'll tell you what will happen. One person gave me an answer, sir, 80 deferred tax reversal multiplied by 35%, 28 reverse in this year. And technically in the third year also 28 will only reverse. So 28 plus 28 only 56 is reversing. Right? But creation is how much? 60.8. So there will be a difference of 4.8 rupees. And this 4.8 rupees will be reversed right now. And sir, it is quite logical. And see, nothing, it is not rocket science at all. It is common sense. See, last year you created a DTL at 38%. And now if the tax rates have fallen down, so reduce the DTL. Na? If you have created at 38 and now the tax rate is 35, bring down to 35, boss. And if, for example, in second year, the tax rate, if it's not 35, say it is 45, then, sir, first I would increase the existing DTL at the rate of 45%. Means 7% I will increase the DTL. And then I will reverse at 45%. Right? So this is now becoming very important. Sir, on 160 timing difference, first 3 rupees. Now what is this? Sorry, 3%. That is 38 minus 35 ka difference. Right? Plus normal reversal, 80 into 35%. So total 32.8 lakhs will be reversed. Total 32.8 lakh will be reversed. Correct? So let us show it in the above working also. DTL reversed will be 32.8, which is a positive figure. Right? No creation. So what will be the final PAT? 420 minus 190 plus 32.8. So what will be the answer? 420 minus 200, 220, 230, 262.8. Right? So journal entry will be what? What is the net difference of these two? 157.2, correct? So PNL has to be debited by 157.2. Right? 190 plus 190 minus 32.8. So let's pass the journal entry now. P&L account debit 157.2. Deferred tax liability account debit 32.8. To provision for tax account 190. Now, so third year is not a problem. Huh? Why? Because tax rates are now constant at 35%. and already whatever deferred tax is recorded in your books is now shifted at 35%. Because see, understand, in the second year, entire 160 lakhs of timing difference you reduced by 3%. You reversed by 3%. And out of this 160, only 80 got reversed. So can I say still 80 rupees of timing difference is pending? That will be now reversed. And sir, on this 80 rupees, at 35% only the deferred tax liability is recorded in the books. That is exactly 28 rupees. And that is what is going to reverse now. And you can cross check also. 60.8 is what you created. Out of that, 32.8 is what you reversed. So sir, the difference is 28. And exactly 28 only will get reversed now. That is 80 rupees of timing difference multiplied by 35% tax rate. So DTL to be reversed will be very simple. 80 multiplied by 35%, that is rupees 28 lakhs. So journal entry of the last year will be passed after we show the adjustment in the P&L account. So let us go first, everybody in the P&L account, and show it over there, and then you can copy down the later points. So DTL is not recognized, rather 28 is reversed. So 175 minus to what will be total 420 minus 175 plus 28. What is the final PAT answer? 273. And sir, the total of all these three will be equal to the total of all these three. It has to be same. 791. 791. It has to be matching. And what is the difference? 147. So 147 is what we have to debit the profit and loss account with for the third year. The difference of 175 and 28. So I'm scrolling down now. So P&L account debit with 147, DTL reverse with 28, and total provision will be created for 175. So please note down the third year also. Yes, sir.
Sir, like just for out of curiosity, why do they like use the future tax rate for this year's DTL? Because is it because it is a future liability that is arising out of the future?
Yes, it is very
Sir,
much correct.
Yes, sir, but it doesn't make sense, right, sir? Although I know it is not followed, but like there are no separate tax rate every year. But still, how will you know like आगे का tax rate क्या होगा? How will you know today, sir? You will
एक
not.
साल का तो पता ही होता है ना, 1 year का तो we are everybody aware.
Okay.
Finance Act 2021 came in February. Right, and Finance Act 20 is applicable to assessment year 20 to 23.
Yes, okay.
And currently now we are in which assessment year now, which will start 21, 22 is going to start.
20.
Right, so we are aware 1 year of tax rate in advance.
Mm-hmm.
So only for 1 year it is possible in India, not greater than 1 year.
Okay.
And such cases where tax rates are different, the matching takes place over a period of 2 or 3 years. You cannot directly go and try to match in the first year itself. Some difference will arise, and difference will be what? Only the difference of tax rate of current year and next year. See, in this question also in first year, your total timing difference is how much? Total timing difference is 160.
Yeah.
Correct. So 160 ka 2% is how much? 3 rupees 20 paisa. And see,
Yes,
देखो इतने का ही difference है. If you create deferred tax at 160 multiplied by 40%, your answer should be 64. But you are creating at 60.8, so difference is 3.2. And this is nothing but 2% of 160. So what they mean to say is, ki, why are you making it 40 now? Because anyhow next year is 38. And anyhow, this is going to reverse in next year. It's a future liability. So please record at the future tax rate only. Na? So whether it is a future asset or a future liability, you please create the asset or liability at the future tax rates only. Because see, we are not here to match the current year. We are going to match here the entire time difference that is arising over a period of 2, 3 or 4 years, as the case may be. Right?
Makes sense. Yes.
Yes, Mani. Aditya, there is a lot of background noise. You please clear the background noise first, and then I'll unmute you. Mani.
Both the total is not same, sir. It's 795 on the accounting and 791 on the IT.
Both are not same. How is that possible? It has to be same.
There is a 4 lakh difference, sir, in accounting.
Please check. No, sir, it's 799. Both sides it is 791. It has to be 791. It should not be different. Please check others also. Many, I think Mani, you should cross check.
Sir, is it fine now?
Yes, please speak,
Yes.
Aditya.
So I just have one doubt. So in the second year, to determine the DTL to be reversed, the logic is that 160 lakh we had created at 38%, but next year it's going to be 35. So you made that 160 into 3% DTL reversing. And this year, any 80 lakh had to be reversed, so you multiplied it by 35.
Correct.
But logic I used was that 80 lakh next year I have to 80 lakh this year was created at 38%. So I did 80 lakh into 38%, and 80 lakh of next year I had to make it on from 38 to 35. So that I did 80 lakh into 3% there, and I got the answer same as 32.8 only. But I
got your point. What you did is in second year you reduced 3% on only 80 lakh, and in third year you reduced 3% in 30 lakh. That is what you have done.
Correct.
Sir, technically that is not correct. I know you got the same answer and you will get the same answer, but sir, it is not correct. Because what accounting standard says, whenever there is a change in tax rate, the whatever is your opening balance of deferred tax. Now this is your opening balance of timing difference to be more correct. Right, so this opening entire has to be reduced or increased accordingly. So you cannot say that out of this 160 only 80 is getting reversed in this year. So to the tune of 80 only I will adjust 3% this year and balance 80 I will adjust in the next year. No, because the logic is what if you don't adjust this year, what will happen? Your 80 rupees of timing difference which is left will be shown in the books at the rate of 38%. And sir, you have to understand the tax rate is 35% now. So whatever deferred tax liability or asset you are showing should be as per 35% only.
Okay, sir, understood.
That is why entire 3% we are reducing on full 160 lakhs.
Correct. I got it, sir. I got that. And sir, one thing, even if they don't mention that the 1 year rates were known, next year's rates were known today, we still have to take next year. If they don't mention.
Exactly, because data is given in the question. No?
Yeah. Okay. Thank you so much.
Correct? Yeah. Now let us quickly come to question number 3. Krishna Limited started business on 1st April 2005. The following details are available from the books of accounts and other records of Krishna Limited. Profit before depreciation and taxes are given for 4 years. 1 minute, let me connect laptop charger. 1 minute. So profit before depreciation and taxes for 4 years are provided, right? Then they have given the company has purchased the following machineries. On 1st April 2005, 4 lakh machinery. On 1st April 2006, 3 lakh machinery. And 1st April 2007, 4 lakh machinery. So 3 machines have been purchased in 3 years. Okay, no problem. The company charges depreciation on machine at 15% per annum. So in books of accounts, 15% per annum depreciation. And whereas the rate of depreciation for income tax purpose is 25% per annum. Correct? Sir, WDV or SLM is not given. So we are considering WDV because in income tax generally only WDV is allowed. So we are following WDV method. In exam you can follow SLM also, choice would be yours, but I would recommend stick to WDV only. The company has no other fixed assets. Thank you very much. Now tax rates for the 5 relevant years are provided. 5 years tax rates are given because technically you have to show the deferred tax calculations for 4 years. So in year 1 tax rate is 50, year 2 45, then 40, then 35, then 35 respectively. So sir, when you are in year 1, you will apply tax rate of second year. When you are in second year, apply tax rate of third year. In third year, apply of fourth year, right? And when in fourth year, apply of the fifth year. Correct? Right? And you can see every year the tax rates are falling down. Means technically in this question you have to create a deferred tax liability. Why? Because income tax debris is greater than accounting debris. So higher expense in income tax. Higher expense means lower profit. Correct? And lower profit means lower tax. So technically deferred tax liability will be created in all the 4 years because reversals are not going to take place only in the first 4 years at least. Because sir, understand, debris rate is high in income tax. So technically at least for first 5 to 6 years, depreciation in income tax will be greater. And I think from the 7th or 8th year, the accounting debris will start to become greater because WDVs will come down. So the amount of depreciations will also come down. So technically, sir, when we will show you the working note, you will say that yes, sir, in all the 4 years, income tax debris is greater than accounting debris. So technically, in all the 4 years, there will only be creation of deferred tax liability. There will be creation of deferred tax liability and only reduction with respect to tax rates that has to be applied on the opening balance. Means in first year you will create at 45%, but when you go to the second year the tax rate has fallen to 40, right? It means whatever you created in the first year at 45% should be reduced to 40%. So only for this tax rate reduction reversal will come, but reversal will not come for timing difference reversal. Reversal of DTL will be coming for reduction in the tax rates every year. It's a wonder. Actually, this is a CA final question. This is not of your inter question. This is not inter-level question. It's a final question. And we have reduced, we have cut short the question. This is actually a 16-mark full-fledged question where there is something more also, but we have removed that something more part of this. And this is the only one more question we had, but we removed it because that was actually very difficult. And I never used to solve that in the class also because it was 16-mark question. Always used to skip it. One or two batches only out of curiosity, I have solved it for the students. But generally, we never used to solve it because then we removed it from the question bank also. Right? So let's go ahead. And sir, some lengthy working notes will be required. I'm doing one thing. I'm going to copy paste some working notes from the morning batch itself because some unnecessary working notes that are unnecessary consuming time, but technically of no use. Means we should not actually waste time on that. That is calculation of depreciation as per books and as per IT. So 4 years of depreciation figures is what important for us. This you can simply calculate. It is common sense, no rocket science. See, first year, debris as per books is 60,000, IT is 1 lakh. Second year, the book depreciation as per books 96,000. After taking additions and all, new assets are purchased, we have added that. But in IT, it is 1,50,000. So first year also IT greater than accounts, Second year also IT greater than accounts. So same situation is going on. Third year depre accounts 141, IT 2,12,000. So again third year IT is greater than accounts. And finally fourth year depre as per books 1,20,000 and depre as per accounts is still 159. So technically in all the 4 years IT depreciation is greater than accounting depre. So I would simply say that in all the 4 years timing difference is only arising. It's not reversing. So what note I will write, in all the 4 years the depreciation as per income tax is greater than depreciation as per books. That is, timing difference is arising in all the 4 years, comma, it's not reversing in any of these years. Correct? The above timing differences will create DTL. So therefore calculation of DTL to be recognized, right? So just copy pasting the table, figures and all, everything I'll be filling this. One column I would like to add over here, one more I would like to add. Okay. I want everybody to please focus. And this is the depreciation that you have to draft, the entire working note. And now this table is very important for us now. Everybody please concentrate on the table now. We'll rub all the figures. We'll start with first year. Now first year depreciation as per income tax is 1 lakh and depreciation as per accounts is 60,000. So can I say timing difference of 40,000 is arising? Correct? So 5, 6. DTL should be 40,000 multiplied by tax rate of the next year, which is 45%. So sir, technically 18,000 DTL to be recognized. Yes or no? Opening balance I'm putting dash. DTL to be recognized is 18,000. Correct? So what should be the closing balance of DTL? Sir, closing balance at the end of the year should be 18,000. And how much net DTL is recognized during the year? Sir, it is 18,000 what we have recorded during the current year. I hope this point is clear. First year is very simple. No problem at all. Now let us go for second year because complications will start from the second year now. So everybody please focus from the second year. Now second year income tax depreciation is 1.5 lakh. See, second year 1.1 lakh 50 and 96 for accounts. So depreciation income tax is 1 lakh 50 and accounting depre is 96,000. So hence creating a timing difference of 54,000. Correct? And can I say you already have opening balance of deferred tax liability at 18,000, which is brought forward from the last year. Why? Because in current year, nothing is getting reversed. Na? So whatever you created last year will also stay with you only. So technically, at the end of fourth year, the timing difference from first year is available till in the fourth year because nothing is getting reversed. So now please check. Sir, in 6, 7, can I say the tax rates have fallen down to 40%? Because in second year, you will apply the tax rate of third year. So third year tax rate is only 40%. So it is fallen down by 5%. Yes or no? So technically, on this 40,000, you recorded at 45%. So on this 40,000, you have to reduce the charge by 2,000. Yes or no? That is 2,000 is nothing but 40,000 multiplied by 5%. Then only your entire closing balance of the deferred tax liability will come to 40% for the entire timing difference. So please see, in 6-7, DTL first recognized will be how much? Sir, new timing difference is 54,000 and on this we have to record 40%. So what is the answer? 21,600, correct? Minus DTL reverse. Now reverse with respect to what? Sir, on 40,000, we have to reverse 5%. Now why this 5% is coming? Because we had recorded last year at 45 and now it is 40. So technically 2,000 rupees we have to reverse. So 19,600 is net DTL recognized. Correct? Net DTL recognized in the current year should be 19,600. So see how I am showing this. DTL recognized 21,600, reverse minus 2. Right? So what will be the total? Total is nothing but opening plus recorded minus reverse. What is the total of these three? This is the closing balance of DTL. What is the closing balance? 37,600. Right? And how much net you have recorded in the current year? Sir, net we have recorded 19,600. And sir, trust me, this 37,600 is what you know? Total timing difference of year 1 and year 2. Total timing difference of year 1 and year 2, 94,000 multiplied by 40%. So logic is what? At the end of each year, you have to review your DTL or DTA and it has to be brought to the applicable tax rates now. So the logic is you have a total timing difference of 94,000. So your deferred tax liability should also be nothing but this total 94,000 multiplied by 40%. So to make this, I had to reverse 2,000 extra. Because in the first year we had created at 45%. So now please learn one thing. Up to the end of second year, now all the timing differences have been brought down to 40%. Right? Now again problem is coming in third year because tax rate is again reducing by 5%. So now technically what we have to do on this entire timing difference of 94,000 which we have now shown at 40% will be further reduced by 5% in the next year. So let us show the third year now. Accounting debris is 212,500. Sorry, taxation debris is 212,500 and accounting debris is 141,600. Can anybody please tell me the difference between these two amounts? 212,500 minus 141,600 difference? 70,900. Thank you. See, I'm putting a double underline because that will not come in the total. In the total only 1, 2, 3 opening plus DTL recorded minus DTL reverse. That becomes the closing balance. Now please check. 7, 8. DTL recognize. Sir, 70,900 is the new timing difference. On this, I have to record it 35%. Can anybody give me answer? 70,900 into 35%. 24,815. But I have to reverse also. Minus DTL reverse. Sir, how much I will reverse? On the cumulative 40,000 of first year and 54,000 of second year, cumulative 94,000 into 5%. And this is what? 40 minus 35. And what is this? 40 plus 54. So what is the answer for this? 94,000 into 5%, 4,700. So after subtracting, what is the net DTL recognized? It is subtracting, not adding. It has to be 20,115. So see how I will fill the figures. Opening balance of DTL is 19,600. Correct? On the current year new timing difference, 24,815 is to be recorded, but 4,700 is to be reversed also. Right? So what is the total of these three? That will become the closing balance. What is the total of these three? $39,715. Hey, no, 39,715 nahi aayega. 39,715 it is. 1 minute, my mistake. Your closing opening balance is, I'm really sorry, 37,600. And I think for that only, Dhara has raised hand. Now please tell, that is what I'm saying, why it is so less amount. What is the total now? Sorry, my mistake. 57,715. And sir, this is nothing but take the cumulative difference, take the cumulative of these three amounts. 94 plus 70,900 will be how much? 164,900. What is the total of these three timing differences? 164,900. So it is nothing but 164,900 multiplied by 35%. And technically, how much net you recorded in the current year? Only 20,115. Don't expect this question in exam, because for 5 marks, such a lengthy question will not come. And my simple suggestion, leave it in exam. Do it at the end. Don't waste time for 5 marks. Not advisable. Go leave this question, leave one page for this. Once you complete entire paper, then come back to this. Because if you start with directly this question, this will eat up at least half an hour. And sir, 5 marks, half an hour, not at all worthy. So they will generally not ask this question. Don't worry. They will not ask for 5 marks. At least this question should be minimum for 10 marks, not for 5. And for 10 marks, if you're giving half an hour, no problem. Fine. Now we go for the last year. Now last year, accounting debris and taxation debris. Taxation debris is 159,375. Accounting debris is 120,360. So what is the difference? No, 150, 57,715 is not the difference. 39,015. I'll write the opening balance first. 57,715. Okay. Now we'll go for the calculation over here. 89. DTL to be recognized. Sir, current year difference is 39,015. And sir, we are safe now because tax rate is 35%. So this year technically nothing is going to be reversed now because everything is already converted at 35% only. So this is 13,655, right? So this is only will be recognized. There will be no reversal. Why? Because sir, till the third year everything is at 35%, and in fourth year also we are making at 35% only. So technically no reversals will come now. So we are safe now. Directly 13,655 will be recorded. Nothing to be reversed. So net recognition will also be 13,655 only. What is the final total? What is the final total? 71,370. And sir, this 71,370 is nothing but take the cumulative of all four timing differences. What is the total of all four timing difference? Two lakh 3,915. 2,03,915 into 35%. This is your answer. So this is a cross verification for the answer. That at the end of fourth year, since nothing has revised, whatever is the total timing difference multiplied by the fourth year, whichever tax rate you are using, that should be the closing balance answer. If you don't get that, means something you have done wrong in the first, second or third year, as the case may be. So this is basically a cross verification. I'll do one thing. I'll show you the calculation from here. Yeah. Yes, Anshul.
Sir, for this reduction in the taxes for the same sum, the last sum we added it, sir, the DTL reversed. That is 160 into 3%. We have added to 80 into 35%. And here,
वहाँ पे सब reverse हो रहा था ना?
sir, इधर भी अच्छा इधर reverse नहीं हुआ ना? Okay.
इधर create हो रहा है, reverse हो रहा है. तो creation and reversal will not be added. Creation and reversal has to be subtracted. Na? Apply common sense. Means at one end you are recording new liability and on one end you are reducing the liability. So recording new plus reverse होगा या recording new minus reverse? अंशुल.
हाँ sir.
समझ रहा मैं क्या बोल रहा हूँ? Are you understanding?
वापस बोलो sir.
अरे last question में you were reversing everything.
Yes sir.
So you added.
Yes sir.
In this question, you are reversing something and you are creating something.
Okay, last time we did not create, we just only read.
We reduced both 160 into 3% was also reversal and 80 into 35% was also reversal. So
okay, total reversal
added.
Okay, total reversal is added.
But here it is what? Something is reversed and something is created.
Okay,
so
the net effect.
Net effect. That is why यहाँ पे we have done minus.
Okay, okay, understood, sir.
Got? Okay. Yes, Aditya.
So, sir, eventually what will happen is the depreciation as per the books after the 4 years will be more than the depreciation as per IT. And
maybe. I don't know. I have not calculated the fifth year. I don't know. If it may happen, it may happen. You can just check on your calculator once. 6,82,040 is the WDV into 15%. Actually, I've lost my calculator is not working today.
Okay, sir. 15%. Yes, sir. 71,000 is the IT, say approx, and 1,02,000 is the books.
How much is books?
1,02,000.
Superb. It is getting reversing from the fifth
In
year.
reverse. Correct. So the if fifth year we would have reversed the DTL.
Yes, if 5 years data would have been given, so we would
Yes,
have
yes.
reversed fifth year by whatever is the timing difference. 1,02,071, na? Matlab 31,000
Yeah,
ka difference is getting reversed.
Mm-hmm. Yes.
So 31,000 multiplied by, if 35% only is the tax rate, so we will reverse at 35%.
30, into 35%.
So
Understood.
technically from fifth year, reversals will start in this question.
Yes, sir. Understood. Thank you.
And from fifth year, there will be reversals only. I'll scroll a bit down. Have you completed have everybody completed the working note depreciation part? Anybody is pending to copy that? Depreciation working note part. I'm scrolling it a bit now. So I hope you have completed with this now. We have to now jump for the next concept, right? Now review and reassessment is done. Measurement of deferred taxes is done. Now I want to add up one small point with respect to deferred tax asset in case of carried forward or brought forward losses. Now please have a look over here. Recognition of deferred tax asset in respect of carried forward losses or unabsorbed depreciation. Now please understand, I don't know whether you are aware about this or not. In Income Tax Act, you have a provision that if you are having a loss in a particular year, that can be carried forward for 8 years, for 8 future years, and can be set off against your profits, which will eventually reduce your tax liabilities, right? So technically that loss is an asset for you, which will reduce your tax liability in the future. So if something is going to reduce your liability in the future, today it is an asset only, right? So always remember, whenever there is a loss, with respect to that loss, now loss as per what? Loss as per income tax provisions, huh? Not loss as per books of accounts, loss as per income tax provisions, right? You will create a deferred tax asset for it. No deferred tax liability, only deferred tax asset will only come, because it is very clear. This loss is going to save your tax in the future, means it is going to reduce your liability in the future. So it's an asset now. But sir, you should create a deferred tax with respect to this carried forward losses and unabsorbed depreciation only if these two conditions are satisfied. Condition number 1, there is virtual certainty plus convincing evidence. Virtual certainty of profit means you can see virtually profits. You can see profits in the future. But sir, only seeing is not enough. Evidence should also be there. So that is why they say virtual certainty plus convincing evidence. And what I have written for convincing evidence means shift of business which can earn profits. Shift of business which can earn profit means, sir, there is a convincing evidence that something is happening in our enterprise or some market scenarios are changing, due to which I can say I will definitely earn the profits which I am seeing. I give you a very good example for this. Dhara, you want to ask something? Please wait for 2 minutes. Let me complete my example. Now what it is, sir, I have a land in my books of accounts. The value of the land, book value is 50 lakh rupees. And I can sell it in the market because it has a fair market value at 1.25 crores. So in this case, I can say I am virtually seeing profits. There is a virtual certainty, and virtually I can see 75 lakh profits. But now let us check whether I have a convincing evidence or not. Now, what is convincing evidence? Please understand. Management is of the opinion that the land should be sold off immediately. So this is your convincing evidence. So if management is ready to sell off the land, means technically you will earn a profit of this 75 lakhs. So there is virtual certainty of profit plus there is convincing evidence. But if 75 lakh profit you can see because fair market value is greater than book value. But sir, management does not want to sell the land. Management is not having any intention to sell the land. So technically there is no convincing evidence. So if you have only virtual certainty and don't have convincing evidence, deferred tax asset cannot be recorded with respect to carried forward losses or unabsorbed debris. So if any exam question comes on this point where there is a business loss and they tell you that you have to create a deferred tax asset, they will 99.9% write that there is virtual certainty also plus there is convincing evidence also. Because if these two are available, then only you can record the deferred tax asset. If these two are not available, deferred tax asset cannot be recorded. Yes, Dhara.
Sir, could you explain this topic again? I had a network issue, so I didn't understand from the beginning.
Which topic?
Recognition of DTA.
What? That is, you are present.
Recognition of DTA, I didn't.
Arey, you are
no,
present.
sir. When you are explaining the example.
Madam.
Sir, when you were explaining the example, I was there.
Oh, just hold. Wait for a minute. Wait, let me complete this part first. Right, I'll get back to you later. Just hold. Now, the simple logic is what? To recognize a deferred tax asset with respect to a carried forward business loss or unabsorbed depreciation, two things are required. Virtual certainty is required, plus you should be having convincing evidence with respect to the profits which you are virtually seeing. Virtual certainty means you are seeing profits in the future. And convincing evidence means whatever profits you are virtually seeing, you should be having a convincing evidence that you will definitely earn that profit also. So if any enterprise says, sir, I am virtually seeing I can earn 5 lakh profit in next 1 month, give me evidence. Sir, evidence is, sir, next month, COVID second wave is going to come. So we were going to sell lot of sanitizers and masks next month. Don't worry. So 5 lakh profit I can see, virtual certainty. Convincing evidence, yes, COVID second wave is coming. So definitely we will be selling lots of sanitizer and mask again. So if these two conditions are satisfied, I can record the deferred tax asset with respect to carried forward business losses and unabsorbed depreciations. I hope you get this point. We have a question based on this, but I'll solve the question at the end. I have to cover 2-3 more concepts of the topic so that the topic gets completed. Actually, this is the question that I've solved, but I'll solve that again. Review, reassessment done, measurement done. Disclosure is pending. Okay, that is not that. Okay. We'll first start with this question is your homework. With full solution, I have given this question. And the concept and one example I'm going to explain you. So with the help of concept and the example that I'm explaining you, you can do this question. This is an extra question, not there in the material. I've extracted this from one of the CA final books, right? Because we don't have a question based on this concept. And actually this concept is not even covered by many people, but still I am covering this because it is a part of AS22. So let us understand what the concept is all about. Now the concept says, deferred tax asset or deferred tax liability recognition during the tax holiday periods. Now sir, tax holiday period means during that particular period of time, say 5 years or 10 years or 15 years, you need not pay any tax to the government. And this is generally covered for export-oriented units, EOUs, in the SEZs. So in the special economic zone, you are opening an export-oriented unit, your 100% tax is not payable on the export profits. If you are selling anything in India, then the tax will be applicable for the Indian profits. But if you are exporting the thing, so you will have an export profit. So on the export profit, 100% tax is exempted. No need to pay. So please understand common sense. If I need not pay any tax, I will not have a tax liability at all. Yes or no? So if I'm not having a tax liability, why the hell will I work out my timing differences? What will I do with the timing differences where I don't have to pay the taxes only? So the concept of matching is not a problem at all, because nothing will be debited in the P&L account because tax is not payable only. Yes or no? So I should have a zero tax expense because I am having a zero current tax. Yes or no? So what AS22 says? Sir, please understand, if the tax holiday period is for 5 years, 5 years, no tax you need to pay. So technically in these 5 years, some timing differences may arise, and whatever has arisen in these 5 years may also get reversed in these 5 years only. So technically, the timing difference which arise as well as reverse in the tax holiday period only, sir, we have to do nothing with that. Deferred taxes cannot be recognized for that. Why? Because sir, we don't have a tax liability. Then why the hell will I record any timing differences at all? So AS22 is very clear. AS22 says no deferred tax asset or liability will be recognized for the timing differences which arise as well as reverse during the tax holiday period. Correct? So whatever arise as well as reverse during the tax holiday period, sir, you have to do nothing for it. But sir, problem is with such type of timing difference which actually arise during the tax holiday period, but sir, technically will reverse after the tax holiday period. So when the reversal is after the tax holiday period, means it has to be adjusting in the P&L account for deferred taxes now, because it is reversing after tax holiday period. So now differences are bound to arise. So AS22 says that deferred, second point I'm reading, deferred tax asset or liability will be recognized only for those timing difference which arise during the tax holiday period but reverse after the tax holiday period. Right? And sir, the biggest question, when to record the deferred tax asset or liability? So I'll say DTA or DTL should be recognized in the year in which timing difference arise. So in the year in which it arises, the same year you have to record the entire deferred tax asset or liability accordingly. So I'll do one thing, rather showing my example, I'll explain this question only. Right? It's one and the same. You can go and check my example in the AS22 PDF. You will understand it because I've written everything. Now check this question. Beta Limited is a full tax-free enterprise for the first 10 years of its existence and is in the second year of its operation now. Depreciation timing difference resulting in a tax liability in year 1 and year 2 is 1,000 lakhs and 2,000 lakhs respectively. From the third year, it is expected that timing difference would reverse each year by 50 lakhs. Assuming tax rate of 40%, you are required to compute the deferred tax liability at the end of second year and any charge to the profit and loss account. Now what they say, depreciation timing difference. Depreciation timing difference resulting in a tax liability in year 1 and year 2 is 1,000 lakhs and 2,000 lakhs respectively. Correct? And they say that from the third year, it is expected that the timing difference would reverse each year by 50 lakhs. So how many years are left? From third year, it is going to reverse. So how many years? 8 years? Right? Now please understand. Depreciation timing difference. 1,000 lakhs in first year timing difference and 2,000 lakhs in second year timing difference. So total depreciation timing difference is 3,000 lakhs. And sir, out of this 3,000 lakhs, right, which are arising in the first and second year, only 50 rupees from third year to 10th year is going to reverse. Right? So technically, 400 rupees, that is 50 into 8 years, 400 rupees will be reversed during the tax holiday period itself. So I would say 400 timing difference arise as well as reversed in the tax holiday period only. So on this 400 rupees, no deferred tax to be recorded. Correct? And this 400 will be considered as reversing from this 1,000 only. Because whatever arises first will reverse first. Right? So you can read the question later on. I'm just showing you the final figures. Timing difference, year 1, 1,000. Timing difference, year 2, 2,000. Arise. Timing difference, reverse from 3 to 10 years, 50 into 8, 400. Therefore, timing difference reverse after 10 years will be what? 1,600. Yes or no? Timing difference that is going to reverse 2,600. More correct. 2,600 will reverse after the 10 years, correct? So DTL in first year. So what I'll say, sir, in first year, 1,000 is arising. Right? But out of this 1,000, can I say 400 is going to reverse in the tax holiday period itself? So balance 600 is going to be reversed after the tax holiday period. So minus 400. So on that 600, you have to create a deferred tax liability at 40%. So 240 lakhs DTL is to be created in year 1. Correct? And DTL in second year will be, sir, already I have 240 lakhs opening balance. Now on the 2,000 of timing difference that is arising in the second year, technically entire 2,000 will be reversing after the 10th year. So on this entire 2,000 at 40%, 800 lakhs. So therefore DTL closing balance at the end of second year should be 240 plus 800, 1,040 lakhs. This should be the closing balance of DTL. That is first year plus second year taken together. See, final answer will be created by charging to the profit and loss account, and the total balance of deferred tax liability account at the end of second year will be rupees 1,040 lakhs. That is 240 lakhs in the first year, 800 lakhs in the second year. So you can read this entire solution and refer to my simple working note that I have done over here. Correct? So this is my concept, and this is the simple example that also I have made that you can refer by yourself. First 5 years tax holiday period, 10-8-6-4-2 timing difference arise, and reversal starts from 4th year. So 10 and 8 reverse in the 4th and 5th year only. So arise, reverse during tax holiday period. So 18 rupees reverse during tax holiday period, no deferred tax to be recognized. But sir, 642 are reversing in the 6th year, 7th year, and 8th year. See, 642 reversal over here. Right? So technically 12 rupees reversed after tax holiday period, recognized deferred taxes during the year in which it has arisen. And see, I have also written timing difference arising first will also reverse first is what is assumed by AS 22. Sir, FIFO, first in, first out, same logic. So whosoever arises first will reverse first, because that is a general confusion amongst the student. Sir, how can you say that exactly this 10 and 8 are only reversing over here? So it's an assumption by AS 22 that whatever arises first will reverse first. As simple as that. Correct? Now, sir, the last part of the chapter, 2 questions we have to solve. This one, which is shown on your screen now, and one more question, that is question number, I think 4 and 5 is left in the from the book. 5th is very simple. It will take only 2 minutes. Right? We have a ready solution for it. Now, please understand. And this was 2 years back. This was a sure shot question that had already guaranteed to my student, and this had come in exam, because this is based on the concept of AMT and MAT. And I think in 2019, when Institute updated the income tax syllabus, they added up AMT. And this provision that I'm teaching you now is actually having a link with AMT. So I had told all my students that since AMT has been introduced by the ICAI for your CA Inter syllabus, and this concept is also on AMT, the question from this part for 5 marks will sure shot come in exam. And that year it had come. And still this question remains important, because in RTP continuously they are repeating this type of questions. Now, what is the logic? Recognition of deferred tax asset or liability when MAT under section 115 JB is liable and AMT under section 115 JC is liable. Now, sir, MAT is applicable. See, I am not going into detail of MAT and AMT, because MAT is not there in your syllabus at all. It is in CA final. You will be learning in direct taxation. AMT is there in your syllabus, but you will be taught in CA Inter direct tax lectures. Right? So I am just going to tell you in short about this topic. Sir, MAT or AMT is one way of calculating tax. The tax rates for MAT and AMT is 18.5% flat to be calculated on the book profits. Now, to calculate the book profit, entire provision is given under 15 JC and 116 15 JB. So when you will learn those sections, you will also learn how to calculate the book profit. And the main intention was to collect minimum this much amount of tax, because MAT full form is minimum alternate tax. Minimum alternate tax, and MAT is applicable to corporates. So it was a grand success for corporates. So they also introduced it for non-corporates and named it as AMT. What is the name? Alternate minimum tax. Just reverse the name, alternate minimum tax. And the simple logic is, AMT, tax as per AMT or tax as per normal provisions of income tax rules. Whichever is higher should be paid. Whichever is higher should be paid. And I'll tell you one way of calculating the book profit. Only one point I'm telling you. Sir, there is one section 35, scientific research, where you can get 150% deduction. So when you are calculating the profit as per normal provisions of income tax and tax as per normal provisions of income tax, you get 150% deduction, correct? Means government is giving you so much deduction, so your taxes are low. But when you calculate the book profit, that 50% additional deduction is cancelled. So automatically, in many cases, your book profits will be greater than the profits as per income tax. And you will be liable to pay MAT or AMT because your tax as per AMT will be greater than the tax as per normal provisions. That can happen. So technical logic is what? Whichever is higher, you have to pay. So why are we learning this over here? Sir, my point is, as per AS 22, current tax, as per AS 22, current tax is always equal to tax liability as per normal provisions of income tax. Always remember, current tax can never be equal to tax liability as per MAT or AMT. Even if MAT or AMT is payable, please don't change my formula. AS 22 says current tax will always be tax as per normal provisions. It will never be tax as per AMT or MAT. Because for the calculation of deferred taxes, you will never consider MAT or AMT. For calculation of deferred taxes, only the tax as per normal provisions of the Income Tax Act has to be considered. So please make a thumb rule. So what it is written? Current tax is not equal to tax liability as per MAT or AMT. So what paragraph I have put over here? Deferred tax asset or liability are not recognized on the basis of section 115 JB or 115 JC, that is MAT or AMT. That is, it is recognized on the basis of normal provisions of income tax. And there is a concept of MAT credit and AMT credit that I am not going into detail. Just remember one thing, MAT credit or AMT credits are never to be recorded as a deferred tax asset. Means you can find them as carried forward losses. You can treat them as carried forward losses, but you cannot make a deferred tax asset out of it. MAT credits and AMT credits you will learn in detail when AMT will be taught to you. In simple language, I will say, if AMT is 1,20,000 and normal income tax is 1 lakh, what you have to pay? 1,20,000. You have to pay to the government 1,20,000. How much extra you are paying as compared to normal provision? 20,000. Sir, that 20,000 is AMT credit. And the benefit of this credit you will get over a period of 15 years. And how you will get the benefit, that I am not going now because then it will go out of syllabus. So in simple terms, I am saying, if you are paying AMT, because AMT is greater than normal provision of income tax, the difference is considered as what? AMT credits, which you can set off. How you can set off, you will learn in income tax. So what is my thumb rule over here? My thumb rule is current tax will always be equal to tax as per the normal provisions of income tax. Even if you are paying MAT, even if you are paying AMT, your current tax will be considered as per normal provisions of income tax. And I have a question based on this, and the similar questions were asked in exam also. So everybody please focus. What is the question? Yeah. From the following details of X Limited for the year ended 31st March 2017, calculate the deferred tax asset or liability as per AS 22. Accounting profit 5 lakh. book profit as per MAT 4,50,000 and income tax profit is only 50,000. Sir, here only you can understand whether it will be a DTL or DTA. Sir, accounting profit 5 lakh, income tax profit only 50,000. So can I say there is a huge timing difference of 4,50,000? And the tax rates given in the question, tax rate given is 30%. So 4,50,000 into 30%, 1,35,000 should be the deferred tax liability. Why? Arey sir, today lesser profit, so lesser tax. So lesser tax means DTL. Yes or no? Right? Then MAT rate is given at 7.5%. Actually, MAT rate is 18.5, but in this question they have given 7.5. So please don't question the question. Why you are 7.5? Solve it as per 7.5 only. Correct? Now, just have a look at the solution first. First, you can see the taxes for all three are calculated to understand what is payable. Is MAT payable or is income tax payable? First, tax as per accounting profit. 5 lakh is accounting profit into 30%, 1,50,000 is your technically tax expense, which should be debited to P&L. Income tax as per, tax as per income tax profit. Sir, only 50,000 is income tax profit into 30%, 15,000. So technically difference of these two is 135, which we already calculated. And that should be your deferred tax liability. Right? And please trust me, I have not even considered MAT for the calculation of DTL. I have considered only what? Income tax profits. Now let us check MAT. Tax as per MAT. What is MAT tax? Sir, book profit multiplied by MAT rate. So book profit is 4.5 lakh multiplied by MAT rate is 7.5%. So 33,750. Now can I say MAT greater than IT? Therefore, MAT payable. Means you have to pay MAT. Correct? No problem, sir. We will pay MAT. But for calculation of deferred tax liability, I will not consider MAT. I will consider only income tax 15,000. Correct? So just check. Tax expense is equal to current tax plus deferred tax. So tax expense is 1,50,000. That is tax as per books of accounts. Plus see current tax. I have not taken 33,750. Current tax I have taken 15,000. So technically, what should be deferred tax? 1,35,000 deferred tax liability. Right? But sir, I understood one thing that you calculated deferred tax liability at 1,35,000 and I agree with you. So what will be now the amount to be debited to PNL? Sir, simple na, in PNL 150 has to be debited na sir. That is 150 is your tax expense. I am agreeing with that. Means 15,000 you will record provision for tax. 1,35,000 you will debit for deferred tax liability. But sir, please understand, you are paying MAT. And MAT is greater than the normal income tax by 18,750. Yes or no? Difference of MAT and income tax 33,750 minus 15,000. Sir, difference is 18,750. And technically we have to pay total 33,750 to government. But how much we are providing in the books? Sir, provision for tax is only for 15. So what about that extra 18,750? That also has to be provided in the books of accounts or not? Because it is payable, na? So sir, that will also be provided in the name of provision for MAT. But that 18,750 will never be considered while calculating DTL. That will be considered separately for debiting to P&L. Right? So for my deferred tax calculation, I have nowhere taken MAT. I have taken tax expense. I have taken current tax as per the normal provisions of income tax. Correct? So amount of tax to be debited in the P&L account. Current tax 1,50,000 plus deferred tax liability. Sorry, current tax 15,000 plus deferred tax liability 1,35,000 plus excess of MAT over current tax 18,750. So total tax that is going to be debited to the PNL will be 1,68,750. And sir, this is the journal entry. PL account debit 168,750. To provision for tax 15,000. To deferred tax liability 1,35,000. And to provision for MAT 18,750. Because sir, technically, if I am paying MAT means 18,750, you have to create an extra provision. That is for sure, because that is payable, right? But what was important from this concept point of view, that sir, while calculating the DTL 1,35,000, I considered current tax as 15,000 only. I did not consider the current tax as 33,750. And this question have come in exam twice. I think 2 times this has come. And you have to solve this in the same manner, because same type of question will come. Same type, no change, exactly copy paste. So you have to give the calculation in this way and just pass the journal entries accordingly. Correct? And I think this is there in my PDF file which I have forwarded. Means which was uploaded on the web. Yes, Aditya.
So just one doubt. In the PL account, the MAT tax, the excess of MAT over current will be included in the provision, right? So I'll create a provision of the 33,750.
Yes. No, I will create a different provision for MAT at 18,750.
Okay.
I will not create total 33,750 for MAT. It's there on there. Okay, Vishal, thank you.
Thank you.
Yes, Ritik.
Sir, the reason why you are not creating, like you're creating a separate provision, is because your provision for tax is your
actual tax.
Actual tax. So that is the reason you have, for presentation purposes, you will create
exactly.
Yeah. Okay, sir.
Right. Now, 2 questions we have to cover. So what I'm doing is, first I am going on with the 4th question, which is a concept based on loss. So I have to show you how the matching concept will come place while creating a deferred tax asset for your carried forward and brought forward losses. And I think for that we have to now visit question number 4. Question number 4, we have to go on. Question number 5 is very small. It will take only 2 or 3 minutes. So we have to focus first on question number 4. Right? Question number 4. A company, ABC Limited, prepares its accounts annually on 31st March. The company has incurred a loss of rupees 1 lakh in the year 2013. And it made a profit of 50,000 and 60,000 in the year 2014 and 2015 respectively. It is assumed that under the tax loss can be carried forward for 8 years for setting off, obviously, and tax rate is 40% at the end of the year 2013. Tax rates are also given to us for the year 2013. It was virtually certain, supported by convincing evidence, that the company would have sufficient taxable income in the future against which unabsorbed depreciation and carried forward of losses can be set off. So can I say convincing evidence, virtual certainty point is given? Because this loss of 1 lakh should be set off against future profits. So you should have a sufficiency of future profit, which is given. So technically for this loss, I can record the deferred tax asset in my books of accounts. Correct? It is also assumed that there is no difference between taxable income and accounting income, except that set off of loss is allowed. Just a minute. Set off of loss is allowed in 2014 and 2015 for tax purpose. Now, please understand, sir, set off of loss concept is available only in income tax. It is not available in accounts. And since it is not available in accounts, matching concept problem arises. And to solve that, we have to record the deferred tax asset. And I will prove it to you also. So what exactly you have to do? Show the extract of P&L account as per books. So technically, you have to draft a profit and loss account for 3 years. That is 2013, 2014, 2015, showing how the deferred tax asset is created and reversed, and how your matching concept gets fulfilled. That is what you have to do. But sir, you will not directly understand if I make a P&L as per books. So to make you first understand, I have to make a profit and loss account as per Income Tax Act also. So that is only for your explanation. In exam, you will not draft the P&L as per income tax. You will draft only P&L as per books of accounts. So I will now take you to the solution. 1 minute. I'll do it again. I just have to copy paste some points. Table and all I need not draft again. Everybody, please first focus on the P&L as per the income tax rules, right? So this is the profit and loss account. You have to please focus, because now I think you will not have that much time to copy down with me, because you have now, since I'm going to send you the PDF with all the solutions, you can later copy down in your notebook. So please focus now. Now, first, as per P&L account, P&L as per income tax. First, I would say in year 2013, I have a loss of 1 lakh, correct? And sir, in your income tax, you have the benefit of setting off the losses before calculating the tax. So you can set off the loss before calculating the taxes. So set off the loss, then calculate the net profit, and on that you have to go for tax. But in accounts, this benefit is not available. So that is why there is a difference between profit arising and matching concept gets violated. Correct? So in the first year, obviously this is the loss, so I cannot set off it. So what is the net profit after set off? Nil. So tax will also be nil. Net profit after tax will also be nil. So how much loss I am going to carry forward from 2013 to 2014? Sir, full 1 lakh. Correct? Let us go to 2014. Sir, in 2014, my income is 50,000 rupees. Can I say from this 50,000, I will set off the loss which I am having, which I've already carried forward from 2013. But entire 1 lakh I cannot set off because profit is only 50,000. So I will set off 50,000 over here. So my net profit after set off will be nil. And technically, I will not pay any tax also, nil. Net profit after tax will also be nil. Right? Now from this 1 lakh, 50,000 I have already set off. So how much further loss I have to set off? Sir, balance is 50,000 loss which I have to set off in the next year. Correct? Now 2015, I have a profit of 60,000. But how much loss I have to set off? Sir, I have only 50,000 of loss to set off. So technically, net profit after set off, I have 10,000 rupees in my hand. And now finally on this 10,000, I am liable to pay 4,000 tax, that is 40%. So net profit in my hand is now 6,000 rupees. So technically, over a period of 3 years, my net profit after tax in hand in total is rupees 60,000. And what is the loss to be carried forward? 0, because everything has been set off. Correct? Is this P&L simple and clear? Because this has got no problem. Because matching concept ka problem has not even arisen yet. Right? But if this is understood, now it will be easy for me to solve the P&L as per accounts. Right? Now I will go for P&L as per accounts. Year by year. I'll rub all the figures off. I'll write them again. Please understand. 2013, I have a loss of 1 lakh. Do everybody agree with this or not? Minus provision for tax. Sir, provision for tax is nothing but your current tax. Do you have to pay anything to the government? Sir, no. Tax, this is your current tax. Nil, right? Nil, no problem. Now arises matching concept problem. Sir, loss is 1 lakh, correct? So on this negative 1 lakh, the tax should also be negative, na sir? Means on negative 1 lakh, 40% tax I will save. Because see, when the answer is positive 1 lakh, you say that on this positive 1 lakh, 40,000 is to be debited as tax expense. So if I am having a negative 1 lakh means, on this 40,000 tax should be credited. Yes or no? As per matching concept, because this is the debit balance, and in every debit you should have a corresponding matching credit. Yes or no? So for the sake of matching concept, I have to record deferred tax asset. And the deferred tax asset will be recorded as 40,000 in year 1 as a positive figure, because when you create a deferred tax asset, the entry is deferred tax asset account debit to P&L. So P&L technically gets a credit. So this is a debit balance and you have a matching credit now. Yes or no? Matched or not? So what is the net profit or loss now? So technically only 60,000 of loss is now left in your P&L after matching concept. Is everybody clear with the matching concept of first year? Why a deferred tax asset is recorded? In simple terms, I explained. If there is a debit balance of 1 lakh, it should have a corresponding credit. And the corresponding credit will be nothing but its tax expense. But now it is not a tax expense, it is a tax saving. Right? Because when you have income, you show it's a tax expense. But when you are already having a loss, how can you again have a tax expense? You will have a tax income, tax savings. Correct? Is first year clear? Right? Even I have shown the small way of explaining this. See, 2013, tax expense should be negative 40,000. Tax expense should be negative 40,000 means it should be credited to P&L. That is equal to current tax. CT is nil. So to match this minus 40,000, I have to put minus 40,000 here. And this minus 40,000 is nothing but create DTL. So when you create create DTA. So when you create a DTA, technically your P&L gets credit. So entry is what? DTA debit 40,000 to PL 40,000. This is the simplest way to understand this. Your tax expense will be negative 40,000. So it is not a tax expense, technically it's a tax saving because you have a loss. Correct? Let's go to the second year now. 2014. We have a 50,000 rupees net profit. Correct?
Sir, second year also provision for tax is 0, ille, nil. Amoy, sir, if it is nil, matching concept, again problem. Because now I have income of 50,000. So to match this income, I should have a relevant tax expense to be debited to P&L. And that is nothing but 50,000 multiplied by 40% means 20,000 should be debited to P&L. So how it will be debited to P&L? In the form of reversal of deferred tax asset. So when I reverse the deferred tax asset, your matching concept fulfills. And logic behind reversing is, there are two logics. One, the matching concept fulfills, and second logic is what? Sir, you set off the loss now. So when you set off the loss means technically now 50,000 of loss is not available. So if loss is not available, the deferred tax asset should also be reversed. So technically when you reverse the deferred tax asset, your matching concept fulfills because your income of 50,000 will be matched with the tax expense of 20,000. So here I will show that 20,000 deferred tax asset will be reversed. That is nothing but 50,000 multiplied by 40%. So net profit in hand will be 30,000. See, I have also shown a small working for 2014 over here. In 2014, 50,000 is net profit. So on 50,000, your tax expense should be 40%. That is 20,000. Yes or no? Current tax is still 0. So here now it should be a plus. Plus deferred tax. Now what is this plus? A deferred tax liability? No. Reverse the deferred tax asset. So see, reverse DTA 20,000. And what is journal entry? P&L account debit 20,000 to deferred tax asset 20,000. So technically P&L is getting debited. And sir, tax expense is 20,000 means P&L should be debited. And it is getting debited. No problem. Correct. So in second year, 20,000 gets debited. Matching concept satisfied. Correct. Now let us check the third year. Sir, third year profit is 60,000. Do we have a provision for tax now? Yes, sir. Last year, 4,000 provision we have to make because we are liable to pay 4,000 to the department. 4,000 provision for tax. Right? No deferred tax asset will be recorded because we are setting off the loss now. And we are setting off the loss means the DTA should be now reversed. Now, how much reversal? Sir, same 20,000, and I'll show you the logic also behind this. Because 50,000 you are setting off in the third year. So the deferred tax asset to the tune of this 50,000 loss should also be reversed. And sir, matching concept also. Na? 16,000 is your net, sorry, 60,000 is your net profit. On that, how much should be tax? 24, na? 24,000, na? See, 24 is getting debited. 4 in the form of provision of tax, 20 in the form of reversal of DTA. So 24 is technically debited to P&L in the last year. And you remain with 36,000 NPAT, and the total of all these three is only 6,000. Right? And I'll show you the third year ka calculation also. 2015, tax expense is equal to current tax plus or minus deferred tax. Right? So 24,000 should be your tax expense. That is nothing but 60,000 multiplied by 40%. Correct? That is equal to current tax over here is now 4,000 because we have to pay 4,000 to the government. Plus 20,000. Now plus 20,000 means we should not create a liability. We should write off the asset. So reverse deferred tax asset. So your journal entry will be what? Technically full 24 should be getting debited to P&L because this should be my tax expense. As per books of accounts. So P&L account debit 24,000. 2 provision for tax 4,000. 2 deferred tax asset 20,000. So technically over a period of 3 years we landed up paying only 4,000 to the department. Why? Because we took the set off of 1 lakh loss.
So out of 1,10,000 profit, 1 lakh loss got set off. So we are left only with 10,000 profit in hand, right? And on that 10,000, we are paying only 4,000 tax. Yes, Ritik.
Sir, but I have a doubt that when you say 50,000 into 40%, 20,000 you write directly. But we cannot show like that, no, sir. It will be 60,000 into 40%, that is 24. Out of that, 4,000 is your provision, and 20 will be your reversal of DTA.
So that is only what we are showing, na?
No, sir. But in the table, you said like it's like same 50,000.
It's shown differently. See, reversal of DTA will be 50,000 into 40% only, na? Reversal of DTA will be 50,000 into 40% only, na? How can reversal be 60,000 into 40? Because reversal is with respect to what? Setting of a loss. So how much loss did you set off in the third year? 50,000.
Okay.
So 50,000 into 40%, 20,000 deferred tax reverse.
Yes, sir. My bad. I got confused.
Right. I'll tell you one more thing also. If this entire Ramayana is not done, still you will get final answer as 6,000 only. Because what will happen if you don't subtract this 40? This will remain as 1 lakh. Right? This will remain as minus 1 lakh. And this will come as 50,000. This will come as 56 because this 20,000 will also not come. So this will come as minus 1 lakh. This will come as 50,000. This will come as 56,000. So the net effect will be still 6,000 only. So sir, why have you did this then? Sir, matching concept. To avoid the violation of matching concept. See, if you are showing a profit of 50,000 in accounts, this should have a corresponding expenditure, and that is the tax expense. See, I'm showing that 20,000. If your income is 60,000, so on this you should have a matching 24,000 tax expense, and that is possible only when you are recording a deferred tax in the first year and reversing it in the second and third year. If you don't show deferred taxes, your final answer will be 6,000 only. I agree that. But sir, matching concept will be violated. You can only check from your end, na, because this 40 will not come. So if this
2020 will also not.
2020 will also not come. So technically this 50,000 net profit, after tax also it will be 50,000 only.
50. And here it will be 56.
Matching is not there, na. And there it will be 56. So if you have earned 50,000 profit, the corresponding tax should be 20,000, which should be debited to P&L.
Correct.
Right? Yeah. So if you don't show this DTA recognized in the first year, na, second and third year also matching will not happen. And sir, first year also it has to be matched, na? Because when you have a profit, then you should have a tax expense. So if you have a loss, you should have a tax saving. So DTA is your tax saver. It is your asset. I hope you understand the logic behind this question, because many people, they just solve this question, but they don't understand the logic. So try to put the logic to many of the people. I hope you're understanding me. Because if you don't show this also, it will show you same final 6,000, but matching concept will be violated. Yes, Aditya.
So just one doubt, sir. So suppose if the two conditions for the recognition of the DTA were not present, in that case, matching concept would have been violated.
Yes, then we don't have an option only.
We don't have an option. Okay.
You don't have an option.
Yes.
Let it get violated then. Now, one more question, last one. Question number 5. Now, I think 10 more minutes, then we can wind up the session. 10 more minutes, but we'll complete it. Already some 5-6 people have left. Okay, that is their choice. They don't want to wait beyond 8:30. No problem. Question number 5. The following are details in the books of ABC Limited. Provision for tax for 3 years are given, and the total value of provision for tax is 750. Advance tax is paid, 3 years data is given, and the total of advance taxes paid is 795 rupees. ABC Limited estimates its deferred tax liabilities to be 100 lakhs and its deferred tax asset to be worth 20 lakhs. How will the above be disclosed? Now please understand, sir, deferred tax liabilities and deferred tax asset can be set off against each other. So liabilities are more. In the balance sheet, you can show it like this: DTL 100 minus DTA 20, net DTL 80 rupees outer column. Correct? Now, if your cash flow statement topic has started, you might have seen that provision for taxes get adjusted against advance taxes for finding out how much cash is actually paid for tax. Have you reached to that level or not? Okay, fine. If not, no problem. Now, sir, logic is what? Income tax does the assessment for you with respect to whatever taxes you are paid to the government. So they will assess and they will tell whether you have done correct or not. So they will pass you an assessment order. So if assessment order is okay, then generally what people do is provision for tax is adjusted against the advance tax that is paid. Because this is a liability, this is an asset. So asset can be set off against the liability. So here you can see the value of asset is greater than the value of liability. So provision for tax can be completely adjusted against advance taxes. So in the balance sheet, it can be shown like this: advance tax 795 minus provision 750. And sir, this can be done. You can set off your provisions against advance tax only when the assessment orders have been passed by the department. Because unless your assessment is not completed, the provision for tax as well as the advance tax with relevant to that year should remain in your balance sheet only. It should not be written off. So see what theory I have put for this. What theory I have put? As per AS 22, the deferred tax liability and the deferred tax asset should be set off against each other only if it belongs to the timing differences arising within the same tax laws. This I think I explained at the beginning of the session also. If it belongs to the same tax laws, then you can set off. And sir, in India, in our questions, we don't have international taxations. We have only Indian taxation. So this problem will never arise. So whatever assets and liabilities of deferred taxes are, will be respect to Indian incomes only. That is first part. Second part is what? Provision for tax and advance taxes can also be set off against each other if the assessments for the same has been completed by the tax authorities. In the given case, the disclosure will be given as follows: balance sheet rupees in lakhs, deferred tax liability 100 in the inner column, minus deferred tax asset 20, outer column 80 rupees. Advance taxes 795 minus provision for tax 750, outer column 45 rupees. So this is the presentation requirement. It's a simple 5-mark question. But these are the two important statements that you have to write in exam. Point wise also you can write if you want. So I'm putting in point wise. Correct. So questions are all covered now from this topic. Now only one point is left, that is discussing the disclosure requirements, and that is not that big. It's a small part. The disclosure and presentation. Presentations, how it is to be presented in the balance sheet. DTA or DTL are of future years, that we also know, because it is of future years. That is why we apply the future tax rates, as simple as that. But can't be discounted to present value. Have we discounted in any of the questions? No. We kept it at the original values only. So they cannot be discounted to present value because even we don't know in which year it will be paid or set off. Means the liability or asset will reverse in which year, even we don't know. So deferred tax asset or liability should always be on undiscounted basis. Means they should be always at the future values only. Disclosure requirements. Deferred tax asset or liability should be separately disclosed from other assets and liabilities. Means it should not become the part of your fixed assets, nor the part of current assets. And nor it should become the part of current liabilities, nor it should become the part of your fixed liabilities. That is your capital or loans. So what they say, for non-corporate enterprises, deferred tax asset should be disclosed above the current assets and below the investments. So for a normal person, for a proprietor or partnership, how you make the balance sheet? Sir, first fixed assets, tangible, intangible. After that, you have investments. And after that, you should have deferred tax asset. And then you can have current assets. And for deferred tax liability, it should be above the current liabilities, but below the loans. So for partnership or proprietor, how you make the liability side? Sir, first capital, then reserves, then secured loans, then unsecured loans, and then will come deferred tax liability. After that, current liability. And for corporate entities, you will learn it in detail in Schedule 3 when you are starting with company final accounts. So follow the Schedule 3 of Companies Act 2013 and also show the breakup of DTA or DTL if both are there. So adjusted, but in the notes to accounts, you have to show the breakup. Right? Then what else? In case of deferred tax asset with respect to losses, you also have to disclose what is the virtual certainty and what is the convincing evidence. That has to be disclosed. Then deferred tax asset or liability should not be merged with current asset or current liability, that I've already told. They should also be distinguished from advance tax and provision for tax. So technically they have to be given a separate disclosure. They should not be merged with anybody. They should not merge with current asset or advance tax. That is basically your deferred taxes asset, deferred tax asset should not be merged with advance tax or current asset. And deferred tax liabilities should not be merged with current liabilities or provision for tax. They have to be shown as a separate figure. And generally, in cases where you have both, people generally set them off, but some people also show it differently for their better understanding of the financial statement. But you can always set them off against each other. Allowed, no problem. So technically, we complete AS 22 over here. And we complete the standard accounting standards syllabus also. Correct?